Hi, this is Keith Schneider, CEO of MarketCage.com, and this is February 7th edition of Market Outlook. So don't forget to sign up by going to our website and filling in so you get this free text and video newsletter every week. And let's get right to the charts and what is definitely a dicey but interesting market. First thing, let's take a look at some of the activity in the key indices, starting with NASDAQ. First thing that I want to emphasize here is that we've now gone into yet another switch of the 50-day moving average moving under the 200. That is a death cross. Now, what's interesting is where it occurred and the reaction. So over the last several days, you can see the market's been definitely reacting to that death cross. A little bit different action a while back where it was already played out and actually sort of marked a short-term bottom as opposed to potentially the beginning of or the continuation of a move under the 200-day moving average. One of the things I like to point out about what we call phase changes at Market Gauge is that when the phase change occurs, it's always better when the actual instrument is close to the key moving averages. It doesn't always do that. So sometimes phase changes lag. Now, in this particular case, it seems that there's definitely a compound effect here. Now, a couple things to note. Pretty good volume on the downside. In fact, we've had several distribution days. Now, the NASDAQ, which was led by the FANG trade, right? Facebook, Amazon, Netflix, and Google, has really given a lot back this year, and you could say it's been defanged. With the exception of Facebook, the other three stocks components definitely under pressure. So what we have is right a newly developing bear phase or death cross that is to be noted. Now, obviously, this whole level here of around 98 is really critical support. Taking a look at Friday's close and the low in August, the panic day, and then the rebound day as well, and a couple of other attempted probes at that level. So you could say 98. Let me put in a trend line here, or at least a horizontal support line, and you can see right here, just below 98. This is a key pivotal point. If we gap through that on Monday, this coming Monday, you could have some really good follow through. I wouldn't be surprised to see the plunge protection team try to protect it. You might get, a panic attack through that level, and then watch carefully because a rebound back through it might be indication of the flush. So what you've got is a situation that's very fluid, requires understanding short-term tactics, certainly the use of the rolling concept of opening ranges, 2, 5, and 30-minute opening ranges are going to be very, very helpful here. So again, you're pretty oversold, certainly on the very short-term RSI. But as you know, things can get much, much more oversold, and this is definitely a trading market. Let's take a look at some of the longer-term charts as well. Now, what's interesting, on the weekly chart, we like to use either the 50 or the 65-week moving average. In this case right here, we're looking at the 65-week moving average, and we've also now closed several weeks under it. Now, that is a big shift, going back from the beginning of this really strong bull market which started in 2011. Did we have a one or two attempts at a probe and a pretty significant probe last August? Absolutely. But this is now pretty convincing. The market is definitely losing its momentum to the upside. And as you can see, even that 65-week moving average that was sharply sloping up, pointing down. So markets under pressure, I would not be surprised to see a lot more as well. So that is something that we definitely want to keep an eye on. All right, let's take a look at the spiders. Similar type situation, although the weakness year to date not quite as pronounced. But then again, the spiders were basically flat last year, where the NASDAQ 100 was up about 7 or 8%, and the FANG trade up, 20, 30, 40%, depending on when you picked up on that theme. So in essence here, spiders making up for some of the lost traction last year. But take a look here. We got a situation where the 50-day, right, is under the 200. So we're already in a sustained bear trend. This is a bear phase now, right? And what's happening is the 50-day is accelerating to the downside. And again, we have a very similar situation in terms of a support level. And as you can see, the spikes here are what you want to watch out for. The spike low just a couple of weeks ago, definitely any close beneath those levels are going to portend to a much further decline. And let's see where we're finding support. And where we would like to do is go to the monthly charts. But actually, before I leave the weekly, what's also interesting to note is the rising 200-week moving average. Now, again, that's been intact since the mid part of 2010. Really, the 200-week moving average really barely has been violated. Even though we're on this downward slope, we traded over it, held it. So this 200-week moving average, really critical, that comes in around 178.50, 179 or so. So that's critical. If we break down there, you can say a break under those levels, right? Very, very important and critical to watch. The count is pretty substantial. You're talking about a potential 30-point move to the downside if we break those levels. So looking at the monthly chart, right, your monthly moving average, which is our 80-month moving average, your next line of support, which, by the way, sort of coincides with the prior tops going back to the highs in 2000 and 2008. That's where that monthly moving average is coming in, the 80-month. So long-term support, definitely around the 155 level, 154. That's a pretty decent sized drop, and that coincides with the count on the topping formation that we saw on the daily and weekly charts. Now let's take a look at some of the internals. Here we have the McClellan oscillator, and what we are is we're still sort of in a overbought and turning over zone. What we're going to see here is if we get beneath the flat level in the McClellan, it'll probably indicate that we're on a sharp move to the downside, and it could be substantial and pretty fast. So we are coming off what I would consider overbought levels, also adding a little bit more concern to the overall picture is on the up-down volume on the short term up-down volume indicator, 10-day, which looks at you know, indications that have weight for the next 5 to 12 to 13 days, is this 10-day up-down volume. We really could not get overbought. So that in itself is indicative as well. That's the up-down volume. The advanced decline here, we were able, again, to get to overbought levels, turn down. But again, you can see we're starting to deteriorate in just how overbought we can get. So again, not a good overall picture for the market internals. Taking a look at market breadth, which is the number of stocks. This is not a moving average. What we were looking at is the McClellan and the 10-day advanced decline, up-down volume indicators. Those are based on a moving average. The other market breadth indicator that I like to use is the spiders. And the number of stocks, which is not a moving average, but the number of stocks above key moving averages. So it's a reading as of Friday. And as you can see, the cyan line is the 10-day down here. And again, the two levels here indicate overbought. The levels down here oversold. And as you can see, on a shorter term basis, the number of stocks above the 10-day moving average got a little bit overbought and has immediately come off. And again, you can see that we're definitely sort of in the mid part on the 200-day, which is the number of stocks above the 200-day moving average is sitting at just above 100, maybe 120 or so, and the number of stocks above the 50-day moving average is right around 200. So we're sort of at a point where the market is neither overbought or oversold on the longer term or the longer term averages. However, we are coming off an overbought reading on the shorter term, the 10-day. So I look at this as a relatively neutral to slightly negative read on the market. In order to get a buy signal, I would like to see all three get at least into an oversold zone. So this rally off the lows has put us in a scenario, certainly, where we can get some more downside and the market is not running as frothy based on this indicator as we would like from that rally off that sort of panic low a couple of weeks ago. Taking a look at market sentiment, interesting situation. Again, we're in a scenario where concern about the market is accelerated. We've moved into a bullish phase on VXX, and that is telling you that there is concern in the market. And if you look at the Bollinger Bands, we're sort of in the midpoint of the Bollinger Bands, so not overbought there either, which means that there's plenty more to go either way. In this particular case, if we lead in favor of the fact that we're in a bullish phase for the VIX, which is bearish for the market, also considering that it's neutral. A move under the 50-day moving average around 22 would probably be telling you that the panic here right now is abating, and that would confirm a move to the upside. Let's take a look at a couple of other interesting ratios. Looking at bonds and the interest rate sector. A lot of people have been talking about junk bonds, especially that there's a lot of junk debt related to the oil patch. And that sometimes is a good indicator looking at the ratio. So this chart here is the ratio between junk debt and 20-year treasuries. And as you can see here, when the red, which is the actual ratio, drops beneath that green line and in general is trending lower, which as you can see, we are, that means that junk debt is losing against U.S. Treasuries. And that is generally a good, or can often be a good market timing signal. When this starts to improve, obviously people running in and trying to get a bigger return because they're not as concerned about defaults in the junk debt arena is a positive for the market. Doesn't always work that way, but often it does. Recently, certainly, it's a good anxiety indicator. And as you can see with this ratio just trending down, lots of concern. And again, this spread indicator is definitely pointing to more turbulence. All right, I'm going to introduce something else as well this week, and this is the spread chart, a ratio between the S&P and the utility sector. The utility sector, as you can see, this is a chart of the utility sector here. This is a chart of the S&P down here. This is a chart of the ratio, and this is the red line is a moving average of the ratio. So whenever we cross above the red line, we're favoring utilities. When the blue crosses over the red, it's favoring utilities. And this simple indicator, whether you're above the blue line, is the blue line penetrating the actual ratio, then you're basically saying people are favoring utilities over more risk, which are stocks. And this particular indicator is pointing to really rising utility prices relative to the S&P. That's dropping. That is not a good sign. Definitely is telling you that more concern. People are moving to safety. That's where utilities are. In fact, with the market down well over 2 to 3% on Friday, the utilities were up 0.5%. So this ratio is improving quite a bit, and not quite at its all-time highs, but it did break through an important resistance area where it had been at the beginning of 2015. So another confirmation about the seriousness and the nature of what the markets are telling us right now, right? Move into utilities, that's really been going on since mid to late December. So that was an early warning indicator that there was some problems lurking in the market. This is something really, if you want one of the simplest, probably one of the more effective market timing models, it's looking at the ratio of utilities versus the S&P with a simple moving average on it. And this is a daily chart with a 20-day moving average. That's what this red line is. And the blue is the absolute ratio. So as you can see, when we crossed above here, it told you to be long utilities, short stocks, or some sort of methodology where you would have reduced your holdings would have worked as well in equities. All right. Another thing that is different this time around is gold. So let's take a look at the gold chart and see what's happening here. One thing that did occur, as you can see, we went into a recovery phase right in the beginning of 2016. Now, we like recovery phases when the 50-day moving average is flattening to moving up. That's a much stronger recovery phase. And take a look at the volume here. Massive volume in gold, and this is certainly a change. You can see the fact that gold with good volume, this is really a first in many years. So the nature of this decline in equities has a different texture to it, for sure. And that's confirmed by gold and how it's acting. Certainly, let's take a look at the longer term chart in gold. Here's a weekly chart. You can see we're sort of in this downward wedge type formation. We hit the bottom. Seasonally, this time of the year is very strong for gold, but more importantly, on the weekly charts, we broke out. We're basically touching and closed through on Friday the 65-week moving average. Now, that has been penetrated a couple times on its way down and then failed. Now, another thing to note is we're certainly starting to get overbought. So I think there's a good potential that gold may have bottomed out on a longer term basis. Can it continue up a bit more? There's some pretty good resistance up around the 114 level in GLD. And interestingly enough, if you go to the monthly chart, and you can see that we're already through the monthly moving average. So that is definitely a potential trend change. And we basically stopped just below a fairly important trend line. Right, so you can see this trend line right here. This is where it stopped on Friday. I wouldn't be surprised to see it pop through and work its way and get a potential opportunity to get in a little bit cheaper. It's running very, very rich. That doesn't mean it can't run a lot richer when gold gets going, especially since it's been so out of favor here. And there's really nowhere else for people who are getting out of the equity markets to move into. So you're seeing this move into gold, into utilities, and let's also take a look at the euro. Similar type of scenario in euro, just not nearly as strong. Look at the volume on a weekly basis. Was it up? No. Actually, looking at the euro here in this ETF, volume was up, but not really huge amount of volume. In addition, we basically stopped right at the 65-week moving average. So if you're taking a look on the shorter term time frames, we're still in a accumulation phase, right? We held this 50-day moving average that's turning up, right? And we're now trading above the 200 with 2 doji days here. So possibly you're flagging. If we can get above this recent action here, just above 110, I think that would confirm that the dollar has really bottomed out, and expect much higher euro prices over the long term, or at least moderately higher, and that the dollar has peaked. Again, interesting scenario. This is a big switch from where we were over the last couple of years, where the dollar was really strong, gold was not reacting on downward moves in equities, and if it was pretty muted. So different complexion to the overall markets. I've given you some interesting reference points. One thing I do want to emphasize is that gold is running rich. Pay attention to gap openings and those opening ranges, because they're going to give you good reference points to trade off of. All right, hope this helps. Stay frosty. It's definitely a interesting and potentially dicey situation. And again, it's anything can happen. These markets are very fluid. So you definitely want to watch how these markets open, how they react off of the openings, and pay attention to that. So as negative or as dicey as the markets look here for potentially more downside movement, we are in some areas pretty well flushed out to the downside, especially on the RSIs and things like that in some of the indices. So you want to be cognizant of that as well. So keep an open mind, keep flexible, but know that the overall structure has definitely shifted here as compared to the last several years. That's it. Bye for now. See you next week. and thanks for watching.